there's a lot of bad news out there, Sean. You're a little bit on the other side of that, right?
I am, and to some extent I think this is what you would have expected from a rate tightening cycle, and also all the mounting pressures that you've had from the big burst in commodity prices nearly 12 months ago, and also the fact that services have only just started to recover from the COVID lockdowns, and they themselves now are suffocating from some of the general demise of some of these indices. So I'm not too unsurprised that things have sort of panned out as we're seeing through these PMIs at the moment. And also you've seen that to some extent through some of the ISM data as well.
Sean, give us a sense, you're looking at all these equities. What are earnings, what are forecasts from them painting for you as the economic picture globally? So you're looking bottom up as opposed to looking top down.
So perhaps the best way to say it is that the bulk of the earnings cuts that we saw in the US post the results season were actually from the consumer sector. It wasn't from the tech, it wasn't from manufacturing, it was actually from the consumer. So about 75% of the cuts came from consumer-related sectors, which is the economy, 75–80% of GDP. So to that extent, again, things are playing out as you would have expected. So that I'm not too, again, I don't think necessarily the downdrafts have been that bad to make very difficult cuts in estimates that perhaps we saw back during the pandemic or during the GFC.
Sean, I'm wondering how you factor in, and we might move into the thick of QT, for example, and maybe a little bit of dollar strength. Are those assumptions you're making that might pose some challenges or not?
That's a very good question. I think we're all focused, of course, on interest rates and the Jackson Hole speech, but the reality is that a sort of 10% move in the trade-weighted dollar is equivalent to about 50 basis points. You've had reasonable widening in credit spreads, and thankfully we've actually seen some relief from oil prices. So that all is a form of choking of growth. It's all a tax on growth. And again, I think looking at things holistically, the Federal Reserve has got financial conditions pretty tight at the moment. And again, I think that plays into the fact that we're sort of not going to have some nasty inflation surprises here on in. I think it's more the fact it's just the rate of change, as the earlier speaker mentioned.
Right, and that's a given, really, for the next at least, 12, 18 months. Favorite sector, favorite market, and why?
Well, I have to say that the US is a much cleaner story for investors. You're sort of coming into the peak narrative on rates and the rate tightening cycle. The curve is inverted, and historically the next move will tend to be some form of easing. Whereas in the rest of the markets, I think Europe is still in a more difficult place in terms of tightening into a pretty difficult inflation environment. Possibly in this region, the story that is starting to unfold with better economic data and perhaps a very cheap currency is Japan. And for me, that probably is the best market to look at coming into year end. And also it's one that there's a manifesting reopening is still going to provide a nice tailwind for earnings.